It's Brian Preston, the money guy.
All right, let's ask sort of a nitty-gritty investment question. This is from Peter. Peter said, with bond yields so low, I wonder if there are any smart alternatives for balancing a retirement portfolio that is heavy in stocks. I know just the other week, Bo mentioned that bonds still have a place in your portfolio, even with yields down, but I was unfortunately busy at work and wasn't as tuned in as I would have preferred. All right, Peter, we're going to give you another go-round at this question. We're in a low interest rate environment, right? And we all know, we do this all the time, that when it comes to fixed income or bonds, when interest rates rise, the value of current bonds go down. When interest rates drop, the value of current bonds go up. So generally speaking, you want to hold bonds when interest rates are high and likely to drop because you'll get some capital appreciation on those bonds. You want to be clever in how you hold bonds. Notice I didn't say you don't want to hold bonds. You want to be clever in how you hold your fixed income when interest rates are low and it seems that they might rise. Now, his question was different, though. His question wasn't specific about bonds. His question was, hey, are there alternatives I ought to think about inside of my portfolio to replace fixed income? That's a really, really nuanced question. So when it comes to like investment return, there are really two components to investment return. The first is the one that we all think of. It's capital appreciation. I buy something for $10 today and tomorrow it's worth $12. My capital is appreciated $2. I've got some growth in there. But the other component of return is income, right? If I own something or I have a cash account and I own it and I get interest paid to me, I get these payments, this income that's generated from it. Well, one of the things that generally happens is that if you're looking for sort of the risk off or the conservative or the fixed income or the bond portion of your portfolio, what you're really doing is you're focusing on that stable asset base with an income component. So his question, are there alternatives? I would look at other types of investments that might generate income in the portfolio and hold a stable asset base. And there are certainly options out there.
Yeah, I get nervous because I will tell you, for our clients, we do try to go. There's some balancing between bonds, equities, and then we do have asset categories that kind of fit in between there. I don't, because we don't do product recommendations on this show, and I don't feel completely comfortable sharing all of that because first of all, I don't think the SEC would love us sharing that type of stuff. And our biggest thing is to help you focus on the key fundamental things as you're growing. This is, higher level stuff when you're trying to balance out income, appreciation, but also giving you stability in your portfolio. If you're getting to the point where you need to graduate beyond index target retirement funds, it might be time to talk to somebody. And I know that's such a punt answer to the question, but it really is, because I'm telling you guys, when you get closer that you're nervous about this type of nuanced thing, you don't know what you don't know. Mm-hmm. And we're also in such a unique time. I mean, Warren Buffett in his most recent letter to shareholders that we'll be covering shortly, he talked about what an uphill battle that bond investors will have in the coming decades. But I want to counter that a little bit. I mean, I completely agree. I'm not going against the oracle whatsoever. But here's the part that we don't know, the timing of it all. Because every central banker in the world right now, because of the crazy balance sheets that all of our governments have done, they are artificially keeping interest rates low on purpose. And if you would have told me last year that the typical bond investor in 2020 would have probably made over 7 to 10%, I'd be like, are you crazy? How is that possible? And nobody else in the market knew it either, because the pandemic hit, interest rates went backwards to where there's even places in the world right now that you have negative interest rates. I don't know that there's going to be any hurry for many central bankers to push those rates up that would have that huge negative impact. But I don't think people will know when that's going to happen. I'm just telling you, just realize this is more complex than us. So know what the value of the bond is in your specific portfolio. Focus on what you can control and then build around it, and that might require some customization. I hate answering a question with a question, but I think when you get to sophistication, it's important.
And I think it's pretty personalized. I mean, even your account structure, whether you have a lot in pre-retire or pre-tax assets versus after-tax assets, will affect the type of alternative exposure you might utilize to satisfy that risk-off piece of your portfolio. But what we're saying is there certainly are options out there that you can utilize, but it's not a one-to-one replacement for fixed income. We still stand by fixed income holds a place in most portfolios, especially well-diversified portfolios for people who are mature in their wealth-building life cycle. And so just because interest rates are low, I would not allow that to push me further out on the risk spectrum than I should be.
Yeah, and pay attention to duration too, because shorter term is probably better in the coming years.
Yep.